Hi, this is Michael Fisher, and what I'd like to do as a part of this series is highlight books that are relevant to the saving and investing channel and some of the concepts that are detailed in the channel and in the videos, as well as concepts that are discussed in further detail in the book Saving and Investing. The book that I'd like to discuss in this particular video is a book called The Big Short, written by Michael Lewis, who's perhaps best known for his other Wall Street book called Liar's Poker, which discusses the bond business of Salomon Brothers in the early 1980s. The book, The Big Short, focuses on events that took place mainly between 2003, 2004, and 2007 and 2008, some of which we still hear about today. In particular, how securitization and the ability to restructure subprime mortgage debt having a BBB rating into debt having a higher rating and for which there was greater appetite fueled the housing bubble until the holders of this restructured debt ultimately in many cases blew up due to the tremendous losses on their books, and how the various market participants of that time interacted in some of the characters that were involved. Firms that blew up include firms like AIG, Bear Stearns, and to some extent Morgan Stanley. How did this take place? Perhaps because of income equality and the recognized public good of home ownership, there were a number of specialty finance companies who allowed borrowers who would otherwise and previously not have had access to capital for home ownership to access capital for home ownership with teaser rates, lower documentation requirements in some cases, and less income verification, and potentially even less equity in the purchase of the home. The real innovation came when this BBB debt was collateralized into tranches of different seniorities, into a tranche that was most likely to be repaid, which ended up being rated AAA, a second tranche that was the second most likely to be repaid that ended up being rated AA, and down from there to an equity tranche, with the AAA rated tranche being the most likely to be repaid, the AA the second most likely, etc. These newly created tranches to investors who relied on the ratings looked attractive as the return was more attractive, as the return or the yield was higher than AAA or AA rated bonds issued by the US government. So basically, with a similar rating and therefore with a suggested similar level of risk, investors could potentially get a better yield or return. So in the end, so the BBB debt was now offered in tranches, some of it rated much higher. The only way things could go wrong effectively is if a large part of the BBB mortgage debt went bad, i.e. the borrowers stopped paying interest and principal on this mortgage debt, then obviously that pool of mortgages would go bad and the cash flows wouldn't go to the tranches either, firstly not to the higher risk part tranches, and then after that through to the other tranches. If the whole pool of BBB mortgages went bad, then obviously all of the tranches, the collateralized tranches, would also go bad. So in the end, you had banks and subprime lenders who wanted to originate loans, borrowers who were caught up in a herd mentality to buy housing and who were able to buy houses that they could never have bought in the past, with documentation that they could barely understand, teaser rates and limited documentation required, and capital that was being provided by firms who were indirectly lending to these subprime borrowers, but doing it through highly rated securities, and who believed that they were buying AAA, AA, and single A securities with a better yield. And you also had a small number of hedge funds who began to realize the insanity of all of this as delinquency rates rose and the ratings began not to look right to them. Hedge funds who could bet that there would be a higher level of defaults on the mortgages than the ratings might suggest by buying cheap insurance on the defaults from firms like AIG. What makes this book particularly good is that it goes through this period not only detailing the events that took place, some of which I've tried to highlight in a nutshell, but it's also done in a way that focuses on the characters that were involved, the different firms and the different personalities, their backgrounds, their natures, what they did before the crisis, before this whole period took place. These characters include well-known and lesser-known hedge fund managers, heads of trading at major Wall Street firms, and characters at firms like AIG, Morgan Stanley, Deutsche Bank, etc. And that's where the book really gets interesting and the meat is sort of put on the bone. Characters like Michael Burry, who started as a hospital intern at Stanford Hospital with a desire and a penchant for late-night securities analysis and a willingness to go through these 130-page bond prospectuses in some cases, and who ended up creating a blog for value investors and turning that into a firm called Scion Capital that had roughly $600 million under management at the end of 2004. In 2005, credit card delinquencies were at an all-time high. The Fed had raised interest rates, but because of new ways of accessing capital through this collateralization of mortgage debt, mortgage rates were still at an all-time low. Given the rating agencies' willingness to assign these AAA ratings to the best part of a pool of formerly BBB rated bonds, there was a lot of demand for these higher interest rate bearing AAA bonds, obviously. And in order to meet demand, more loans had to be made. On the other hand, as long as more loans were being made, the housing bubble would continue, fueled by these cheap mortgages and refinancing, and it worked until it didn't, in particular until default rates rose due to lack of income verification and bad labeling on the part of the rating agencies, and it really cracked and imploded in the end. And that's where some of these hedge funds made tremendous returns by being short these pools of mortgages, hence the title The Big Short. It's a great book. It's really insightful into the events that took place in this period. It's interesting for anyone that would like to know more about what happened during that period, about market psychology and good narrative. It's a good way of putting some of these financial literacy concepts and financial concepts into practice, and it's tremendously entertaining, particularly because it goes through more than the events. There is the backdrop of the events of the period, some of which are still being discussed today, in particular in light of the bailouts that took place, the subsequent bonuses that were being paid, the rating agencies' role in all of this, the way that some of these restructured, collateralized bonds were presented to investors who ended up taking the losses, and so forth. Overall, a very entertaining book, The Big Short.